Is there unseen risk stalking your portfolio? I got this article from Yahoo Finance from one of our clients. Thanks, John. This is a good one. It was talking about how the boomers in the United States, if they start to pull money out, or when they start to pull money out of the stock market, how it was just going to crash the market, or it really could crash the market, and how the market could go down significantly because of the fact that when they pull money out, who's going to buy the stocks that they're selling? Well, I thought it was very interesting that in the article he was talking about, who's going to step up to bid underneath the boomers' stock sales. Now, this shows a misunderstanding about what really drives market returns. In essence, what happens is that when people sell, there is always what? A buyer on the other side. And what's happening is if somebody sells, they are giving up the rights to whatever income stream that they were getting from that asset. Like for example, if somebody gives up a CD, let's say that somebody gets rid of their CD, they sell it back to the bank, so to speak, and then somebody else buys a CD. What's going to happen is the interest that the person gave up, who sold the CD or got rid of the CD, will now be received by the new buyer. Same thing with stocks. When you get rid of a stock, the profits that you were receiving, the earnings that you were receiving are going to be received by somebody else, a new buyer. And what happens is those earnings are a valuable asset to be had. Now, just because somebody sells a stock doesn't necessarily mean that the stock will go down in value. Yes, supply and demand does drive the stock market to some extent, but it's a very temporary thing. I'll talk more about that on the radio show this weekend and get more into detail. But if you think about it, let's say if we're talking about companies and we're talking about the companies that we're selling and we're worried about the profitability going away because boomers are retiring or something like that. That's not necessarily the case because there's several things that happen. Number one, companies will actually find ways to sell things to boomers who are retiring. They'll find products that those boomers need to buy, maybe for their health care or for their style of life that they like to live in retirement. Also, if you think about it, American investors, what do? We invest in international stocks. Well, you ever thought about it that a lot of international investors invest in American stocks so that demand will pick up from a different source? Maybe a younger investor that is overseas, perhaps. Also, other things that companies do is, let's say if there is not enough demand for the products that they make here in the United States, they'll go overseas. Maybe they'll even move some operations overseas. So it's really not something that you necessarily need to worry about a whole lot. I thought it was kind of funny in the article he was talking about that younger investors are avoiding stocks. Well, it reminds me an awful lot of what happened in the 1970s. In late 1979, there were articles being written talking about how younger investors were avoiding stocks completely because they were so scared about the stock market at that point in time. It didn't stop the market from going up 500% in the U.S. and 800% in international markets. So this is one of those articles that I look at and say, this just gets a lot of people worked up over nothing and gets them to speculate and gamble with their money. Never a real good idea when you're investing. Hope this helps, and like I said, on the radio show this weekend, I'll cover this more in detail. We'll catch you later.